Welcome back, everyone. I decided it was probably about time that I went through the public portfolio and had some updates. Am I thinking of buying more, selling? Have I sold? And so that's what today is. Now, just as a reminder, this is just me looking at and talking about stocks that I mentioned in the past that I've bought on this channel. So obviously, the disclosure is I own these positions, but that does not make anything investment advice. So aside from the two positions that I mentioned in the past that I was out of, starting from the bottom, the true bottom is Arch Resources. So with Arch, it wasn't the largest position, so I don't really look at it every day. So when I saw that it hadn't really performed, originally I kind of assumed I was wrong and that they lost value and that, it was destined to be a tax loss position. I thought, I bought it at the wrong time, obviously. The convertibles hurt value, and, Lear South was closer, so that's a positive, the growth. And so I kind of thought, okay, Lear South, once I get the re-rating, that'll be probably it. But that was, as it turns out, kind of based on a false assumption because I had another closer look, and coking coal hasn't really rebounded like most of the commodities. And it's still priced kind of unsustainably low considering if it's going to have a continued future. And at the same time, steel demand seems to be recovering well, while input price, coking coal in this instance, hasn't. And so looking at the sector, I think that in the future, at least in the near to midterm, coking coal will be essential for the continued production of steel. Will that last forever? I don't know. But you look at commodities and how cyclical things work, the capex in the sector since 2016 has been half or less than the capex was from 2010 to 2014. And to me, that basically looks like a down cycle and what you'd expect um, to see in a down cycle. And down cycles breed up cycles. So really, when I had my recent look, I'm more so close to adding to the sector rather than my original thought of this will be a tax loss. Next is a relatively new position, and that is the Aecon Group. So as I said, Aecon is a newer position, and I recently made a video about it, a stock I'm buying for my buy and forget portfolio. And I think this is growth at a very reasonable price because if you look at the past 5 years, the stock has been basically flat despite substantial earnings growth. And I think eventually, as things get back to normal, the earnings will accelerate, and all of a sudden, the stock will either look very cheap or break out to new, at least intermediate term, highs because I believe that's where it should be priced. Now, I know it's had a bit of a run in recent months, and some people may be thinking, oh, I missed it. It's already back to, where it used to trade. And I think this chart shows that that's very much not the case, because this is a chart of the valuation that it has historically traded at. And as you can see, at least in the past, I mean, most of the time, it doesn't really trade this cheaply. And now, is that to say it can't pull back? No, it can, the price can do whatever it is. But my point is, what I look at it for entry is valuation. And this seems to be not only a reasonable valuation, but, if it can go, if the stock goes sideways and the company gets cheaper, that's fine. In fact, that's great. And so that's what I see in the Aecon Group, or Aecon Group. Next, another new position. Both of them are basically flat, this and Aecon. This is Dream Unlimited. So as I said, this is a newer position, and I made a video all about it. If you're interested, a new stock to dream about or something like that. And many of you probably know or have seen that I am pretty biased towards hard assets, especially real estate. There's reasons when I could get it at a reasonable price. And I think that this is, what they say about real estate. location, location, location. And this is prime real estate, prime location, and I think it's a great price. So this is kind of similar to when I made a video about Linamar many months ago. It's high conviction. I really like the risk reward, and I think the stock's going to probably at least double if patience is applied. Next on the list is Dynacor Gold Mines, which is slightly up. So I'm still long Dynacor. It is a gold stock without tons of leverage to gold, but it is sensitive to the gold price. I think that the expansion from 330 tons per day to 420 tons per day, which is a 27% increase, market either doesn't care or hasn't really thought about it. Plus, the expansion to Senegal in a few years could really do stuff to earnings. And in the meantime, I think that while the growth isn't priced in, the balance sheet is very solid, stock is cheap, and pays now a monthly dividend. Again, I'll show you more in a second, but the stock hasn't gone anywhere since 2015, whereas the throughput, how much money they can make, is higher, and the gold price is higher. So here you can kind of see that although the price hasn't gone anywhere for a long, long time, the valuation has not been lower since, like I said, 2015 or parts of last year, I guess. But this is coming at a time where growth in throughput and in Senegal is close. And so I think that those things will kind of start to line up. The earnings will increase, and we may have a situation where the price kind of breaks out and people take a look again. Next on the list, up by a third, is Melcor Developments. So Melcor Developments still trades at about a third of book. And again, land plus real estate, kind of at a third of book is interesting. Very interesting, some might say, but depends on what type of growth. Now, the growth at Melcor hasn't been fantastic over the medium term, but they are very based in the oil economy. And, that has done pretty terribly for a long time, but again, is cyclical. So, it's in an interesting spot for me. Plus, you have, people like Brookfield that say master planning and real estate development is a very good business on a risk-adjusted basis, but the public market often doesn't appreciate it. So if you have a stock that's kind of struggled for a while because, even if they've been doing their thing, but the market hasn't been appreciating it, I think that, at some point there's a potential for a catch-up trade to be made. And I think that this is very cheap, and I'm very happy to sit on it for, at this price, I'll sit on it for a long time and get paid a dividend. Personally, I'm a believer in the suburban life where feasible, and seems recently some people seem to be converting to that. And, I've seen a number of peers talk about how surprisingly strong housing has been. Housing development, some peers are saying they're out of inventory, they need more inventory, and that sounds like would be a good time to have land. And, there's just a lot of reasons why you could kind of sleep on this stock. And you can see again, the growth hasn't really stopped. It hasn't been a quick grower in the past number of years, but it's kept kind of in the right direction. Meanwhile, even after the recovery that we've had so far, the stock is trading at a valuation similar to the depths of 2009. So is there plenty of value that can be realized? I believe there is. Will it be realized tomorrow? I have no idea, but at this price, I'm not really rushing to sell by any means. Next on the list is Uranium Participation Corp. Up again about a third. So with Uranium Participation Corp, what I can say is up until now, I've been doing my part. I bought it at a rather large discount, thinking someday we'd see a premium at higher prices. And, well, I was kind of half right, I guess. I hope they figure out a way of using this premium, and I believe Uranium Participation Corp or uranium prices should go higher. And whatever you want to say about the uranium stocks, what I would say about the uranium price is it's still low. And so at a slight premium to that is still low. And the way I like to look at Participation Corp is, okay, what price does this effectively mean I'm buying uranium at? Where's my target? And what's the expected return? And as long as that's still, good enough, then it's still a decent option. And at the same time, if you're buying it at a 20% discount or a 20% premium, but if the uranium price is the same, it's the same opportunity for the company in that they could arb and add value. So far, though, they haven't. And I don't really understand the reasoning. I think they should be capitalizing on it, but maybe it's just taking some time. So we'll see what happens there. Next up, about 70%, but down since the last time I spoke about it, is Methanex. So Methanex, again, I mentioned this last time, wasn't that large of a position. And I kind of assumed, again, because I'm bad at watching smaller positions, but I assumed that it was getting squeezed by higher nat gas prices against the price of methanol. Turns out I was wrong. I looked at the price of methanol, and at this price, historically, it should be trading at 80 plus. And if they can re-get their production back on schedule, then next year it could be, or it should be 120, but it's not. And I'm wondering if another kind of throwaway comment that I made might be impactful here. And one of the things I said was I was expecting multiple contraction in oil. Now, that if that proves to be correct, then it could be that I kind of half made a mistake or with valuations or de-smarted myself. And that is because, if oil faces a multiple contraction, it could be broad-based fossil fuel energy faces a multiple contraction. So it's possible that Methanex is suffering from that call. But again, this is a growing company, so my thesis was buy low, buy when the methanol price is low, and sell when the methanol price is high and the company has appreciated. Well, the company hasn't really necessarily appreciated to where I think it should be. So for now, it looks like something that feels like it should be closer to double the price it is now. So I'm watching to see how this develops. Maybe I was wrong with what the valuation should be, but based on history, it seems like an interesting time for this. And here's what I mean by the methanol price has been recovering, but the company has kind of flatlined, even though this price historically has been high enough to support a higher equity price, realistically. Next, we have Verde Ag, which has had a bit of a move recently, so might be some stuff to talk about. So Verde is rather difficult to predict. On one hand, they're on track, and I really, really like the fact that they were able to make profits at the cycle lows. They're, permitted for more than double the production that they achieved last year, and we'll have to see what this new BAX does to their profitability and the new PFS, FS, whatever they want to call it. It will probably increase it, but again, the NPV on the PFS is not the biggest deal here. The biggest question is, in the near term, what's the price of the commodity that they're selling? What is the volume that they're able to sell? And what type of valuation does the market want to give that? Now, most of the peers will trade at 8 times EBITDA. So at 8 times EBITDA, they're basically expecting guidance in 2021 at this point, at this price, and that's basically it. So the question here has to be, will the market look beyond 2021? Will the price be higher than what I say in that estimate? And will they make their targets? And so for that reason, this is a hard one to judge. I haven't sold any because I think that success in 2021 is to some degree likely. Will they miss their target? I don't think so. If they do, is it a complete disaster? I don't think so. So for that reason, it may be a few months ahead, but I still like the risk reward longer term. So for that reason, I'm still holding and I'm still pretty bullish on Verde. Might not buy it tomorrow, but overall, I like the prospects. Now, the third largest position and the second best performing stock in the portfolio is Stelco. Now, Stelco has been at the same time great and frustrating because the steel prices have gone up a lot and frankly higher and faster than I had anticipated when I was buying Stelco. But the multiple has just contracted so much because at this price through the year, Stelco would have EBITDA of about 2.5 billion Canadian, and their market cap is about 2.5 billion Canadian. So if the steel price doesn't fall, they're basically trading at 1 times their EBITDA. But the question to me is, given that the market doesn't want to give them a multiple, what will drive them higher? And honestly, I don't know what the single catalyst is, but even compared to peers, their price estimates and price targets are just ridiculous. Peers trade at 4 times forward EBITDA estimates. And so when I plug in like the price of steel across the curve into a spreadsheet and subtract 15% for hedged and give them no earnings on that, no EBITDA on that. And then I say, okay, well, what should EBITDA estimates be today? Well, based on them trading at 4 times that, 3.5 times that, I get a price target of $83 a share compared to the 20 something high that they are now. So with Stelco, anytime I look at should I sell, I have a few issues. The first is at these steel prices, you're making 10% on your investment per month at this Stelco price. The second is tax implications, meaning I haven't owned the stock for a year yet, meaning the tax rate would be higher if I sold. So when it does become 1 year old, I'll probably be thinking closer about trimming or selling. The other thing is, if you kind of estimate where the prices have been since the end of the last quarter and where we are now in the next quarter, they're probably sitting on about $400+ million in cash, Canadian, so less relevant, but still. And think about, they're a low-cost producer. So that much cash, low-cost producer, they're not going bankrupt anytime soon. They shouldn't be. And so the other thing that I really don't understand is if you look at a number of steel stocks, their prices now are lower than in 2018 when steel was 50% lower. And the thing is, that's more than 50% of margin, that improvement, because if the cost is 600 and steel price is 900, well, that's decent margin. But if your cost is 600 and the steel price is 1,200, it's double the margin. And yet many steel stocks are lower than in 2018, and in Stelco's case, it's approximately the same level, but they have more capacity and lower costs. So I just can't square this with rush to sell the stock. It doesn't make sense. I think the whole sector should probably be significantly higher. But again, the prices of steel are high now. Next at number 2 at slightly more than double is Linamar. Now it's at number 2 instead of number 4, I guess, because I did double dip on the position, bought more later at a higher price. So Linamar quite honestly exceeded my forecast, particularly in Q3. That was a great quarter and I was not expecting anything that good. But again, I'm not in a hurry to sell because on one hand, again, the tax haven't held it for a year. On the other, it's really not firing on all cylinders yet. You look at the chip shortage that has been impactful and will probably continue to be impactful near term. And you look at, we're kind of still early in the auto cycle. In the meantime, the company trades at, a handful times EBITDA and has had a great track record of growing in the past. And, there's a few cycles that are kind of looking up. And in the meantime, you have a company that's cheaper than its peers, has a great history of growth, and despite all of the near-term challenges, is still expecting double-digit growth next year. And historically, they have underpromised and over-delivered. And so it's closer, I would say it's closer to a balanced risk-reward. I still think that it's a great company and it has higher to go. And, if I'm wrong and if it doesn't, it's not going to kill me. Not to mention that as of the end of the last quarter, their net debt to EBITDA was very low. So their balance sheet was very healthy. Net debt to EBITDA at 0.5, which means now it's probably under that. There's a lot of companies out there that look at 3 or 2, and here the balance sheet they're able to make an acquisition if they want with debt. Again, I throw around terms like great company, and I think this chart really kind of shows why I think that, because you can see in the green line, that's their book value per share. So the last 10 years, they've grown their book value per share, and they've grown it a lot. And in the meantime, the black is what the market has, how much the market has cared about that. And you can see that even now, where they're near their highs in share price, their valuation based on the book at least has been, higher for most of the last 10 years. Now, of course, recently and in the recent environment, it's been lower, but, they just keep growing. And for that reason, I'm really not in a hurry to sell this one. Last but certainly not least is Global Atomic. So Global Atomic has obviously done pretty decently. If you look at it compared to many of the peers in uranium, many of them have gone up. It's gone up a bit more than some and less than others. But I think that now it's closer to in line with the group. However, that is again discounting the zinc asset. So I think realistically it went from free uranium asset to now at a point where it's a uranium asset, much like many of the others, but a free zinc asset. So on the uranium front, clearly the equities are anticipating something. What that is, to what degree a future is being priced right now, I don't know. The prices last time were questionable. The prices now relative to $30 uranium are questionable, but relative to where I think uranium is going to get, I think the net asset values will be quite a bit higher than where the stocks are trading at now. Not to mention the fact that last time, and probably to some extent somewhere this time, the equities have traded at premiums to their net asset values, either on takeout or once they've reached production. So, not all of them will reach production, and, some may be taken out, less than NAV, some more, but the debate of peak cycle pricing, I think, is still a ways away. And so that's the portfolio. I know I've received a few questions of, have you sold anything? And I haven't made a video saying I've sold anything, and I haven't sold anything in this portfolio. I will try to keep people updated within a brief period of when I sell, if I sell. For the equities in this portfolio and the 2021 variant, so add the other two, for those stocks at least. That said, for the prior portfolio, that is the one I made with weekly updates from November of 2018 to November of 2019. That one I won't be following anymore. I just wanted to address that once and for all. The structure was wrong. I forced myself to add things every week. Bad idea. Got too messy. Got to be, because I was forcing myself to pick things. Some things I were on my watch list and I didn't actually own. Point is, way too messy. I'm not trying to hide that due to poor results. I mean, it's up decently since I made it, but I just wanted to clarify that I won't be following that one anymore. Now that's all for today. I hope everyone enjoyed, particularly because this is for entertainment, not advice. Note, I do have other positions, particularly in uranium. These are just the positions that I mentioned on the channel approximately when I entered them. Note also, these are not the actual size of my positions. And with that, I will wish everyone a great day and hope that some of you could tell me which position you like the best and which position you think I should sell. And I hope to hear that in the comments, and have a great day.